Hi, Gary DeWaal here, and this is another Bridging the Week for September 30th to October 4th, and today is October 7th, 2013. Good morning. Last week, the lights went dark at the CFTC in Washington, D.C., but this did not stop what Chairman Gensler of the CFTC has termed a quote-unquote paradigm shift when trading of swaps on swap execution facilities began on October 2nd. But the inauguration of SEFs was not the only important news impacting the financial services industry last week. Last week, the UK Financial Conduct Authority took disciplinary action against a UK-based compliance officer, while the US Securities and Exchange Commission issued important guidance regarding what activities compliance and legal officers at broker-dealers can take in furtherance of their roles without being regarded as supervisors of business line personnel and potentially being liable for such persons' violation of law under a failure to supervise theory. In the UK action, Alison Moran, the former compliance officer of Catalyst Investment Group Limited, a UK-based company authorized by the FCA to engage in a wide range of investment activities, was fined for her role in permitting the company to engage in misleading promotions to financial intermediaries and retail customers. What happened here was that from October 2007 through May 2010, Catalyst had promoted and arranged transactions involving bonds for ARM, a Luxembourg incorporated securitization vehicle. However, beginning in November 2007, ARM believed it required a license from the Luxembourg financial regulator, known as CSSF, to issue such bonds. However, ARM never obtained such a license. According to the FCA, Catalyst 1. became aware of ARM's views on licensing during November 2007, 2. knew ARM applied for a license from CSSF in July 2009, yet 3. continued to promote and arrange transactions in ARM bonds through May 2010, knowing that ARM never obtained the license. This was even after CSSF issued a notice in November 2009 expressly requiring ARM to cease promoting and arranging transactions in ARM bonds until it was licensed, and Catalyst became aware of this notice too. Previously, on July 27, 2009, Ms. Moran also became aware that ARM had earlier that month applied for a license from CSSF. In early December 2009, Ms. Moran became aware of CSSF's notice to ARM to cease issuing bonds, and in late December 2009, Ms. Moran became aware it was mandatory for ARM to have a license to issue bonds. However, apparently, Ms. Moran did nothing with her information and permitted the firm to issue misleading promotional literature regarding ARM bonds to financial intermediaries and ultimate clients. As a result, FCA charged Ms. Moran with a breach of its Principle 6, which required her to exercise due skill, care, and diligence in managing Catalyst compliance function. Ms. Moran simultaneously settled this matter for a fine of Great Britain pounds 20,000, or the equivalent of 32,000 US dollars, while Catalyst was censored. Were Catalyst able to pay a fine, FCA says it would have fined the company 450,000 Great Britain pounds, or 721,000 US dollars. The former CEO of Catalyst and one of its directors were fined and received other sanctions from FCA too. Separately, on September 30th, the US SEC issued a frequently asked questions about the potential liability of compliance and legal personnel of US registered broker-dealers for failure to supervise. While acknowledging, quote, the critical role, end quote, compliance and legal personnel perform in efforts by broker-dealers to comply with legal and regulatory requirements, applicable law, quote, does not presume that a broker-dealer's compliance or legal personnel are supervisors solely by virtue of their compliance or legal functions, end quote. This is good news. However, claims the SEC, liability for supervision requires a, quote, fact and circumstances determination, and applying this, compliance and legal personnel can be deemed business line supervisors, even when according to company organization charts, they are not. According to the SEC, quote, the question is whether compliance or legal personnel have supervisory authority over business units or other personnel outside the compliance and legal departments, as could be the case, for example, if a chief executive or operating officer also is the firm's chief compliance officer. End of quote. Well, that makes sense. The SEC also says supervisory authority also can be implicitly delegated to or assumed by compliance or legal personnel. End of quote. Although the SEC's frequently asked questions did not break new ground, you will recall the controversial John Gutfreund SEC decision in 1992, they are reminded the compliance and legal personnel at broker-dealers that the SEC might seek to hold them liable for violations of law by business line personnel. This might happen by finding that supervision of such persons implicitly was delegated to them, even where there was no express delegation. These two matters, the Moran matter in the UK and the SEC frequently asked questions on opposite side Atlantic Ocean, serve as a vivid reminder that the life of CCOs is surely getting more and more risky. For details regarding the obligation of CCOs under new CFTC regulations, as well as their obligations in connection with preparing their firm's annual compliance report, check out an article on this website first published on September 4th. The CFTC again last week charged and settled with a Futures Commission merchant related to its violations of requirements related to the handling of customer funds. In this matter involving ADM Investor Services, Inc., the firm included in its positions and funds separately set aside for customers, as required by applicable law and regulations, positions and funds associated with accounts of various of its affiliates. These accounts should have been considered non-customer, says the CFTC, and not included among customer segregated funds. For this offense, ADM was fined $425,000 US. Wow. Another week, another segregation violation charged by the CFTC. Last week, the CFTC issued a flurry of no-action relief to accommodate the rollout of swap execution facilities on October 2nd, just prior to closing its stores on October 1st. Among the no-action relief granted was relief to Yield Broker, an Australian-based and regulated multilateral trading facility that offers swaps to buyers and sellers, including U.S. persons. Under the relief, until November 1st at 12:01 a.m., Yield Broker may continue to accommodate U.S. persons without being registered as a swap execution facility. No equivalent relief was granted to any European-based multilateral trading facility. However, boy, this must have infuriated Michelle Barnier, who sought a 5-month delay from the CFTC regarding the applicability of SEF registration requirements to European MTFs and got nothing. Also granted relief were clearing FCMs at SEFs, as they were provided additional time to pre-screen orders automatically for compliance with risk-based limits, and certain SEFs got relief as they were granted additional time to comply with their requirements to facilitate such pre-screening by clearing FCMs. This relief also expires as of 12:01 a.m. on November 1st, and SEFs seeking to take advantage of the relief must file certain information with the CFTC by October 10th. Last week, the European Securities and Market Authority, or ESMA, issued final guidelines on the reporting obligations of alternative investment fund managers. These are hedge funds, private equity, and real estate funds. Among other matters, alternative investment funds will have to report to their national supervisors on a regular basis information related to their investment strategies, exposure, and portfolio concentration. ESMA also proposed that alternative investment funds be required to report information related to their risk measures, liquidity profile, and leverage. there'll be some time until national supervisors actually adopt these rules and roll them out. And last but not least, Eurex announced on September 27th that beginning December 1st, it will introduce its order to trade calculation regime. If during a month a Eurex participant's order volume exceeds the exchange established order volume limit for a particular product, the participant may be fined by Eurex. Also on December 1st, Eurex will be introducing daily limits for the number of transactions sent by a participant and assessing fees for transactions in excess of those limits. These are all efforts to clamp down on high-frequency trading. Last week, the CFTC also issued a frequently asked questions guidance regarding commodity options and brought an enforcement action against a New York floor broker who did not produce required books and records asserting his Fifth Amendment right against self-incrimination. The CFTC did not think that that was an appropriate assertion in connection with required books and records. In any case, I give full detail on those two matters, as well as more details on the other matters and some valuable lessons learned covered on this video in the article overview section of Bridging the Week on this website. Well, let's see if the CFTC comes back to work this week, or if the U.S. Congress continues to serve as the poster boy or girl for dysfunctionality to other legislative bodies around the world. Until then, this is Gary DeWaal. Have a great week.